All right, so I'm going to give you an update on my job, which is making sure that the actual vault makes money. So my job is to make sure that we are doing things that are sensible, that we're doing things that are likely to make money, and I'm overseeing our researchers and our developers in essentially creating the system that trades for you. Um, if you had my job, it would be completely rational of you to be terrified. Um, Trading's really hard. Like even though at times it looks very easy, like at times, everything is racing up, everyone is making money doing the dumbest thing imaginable, and it seems like it's very easy to make money. But like making money and keeping money are different things. Making money sustainably in any kind of market environment is a different thing to aping every single piece of shit when everything is moving up. So my job is to look at what we know about markets, what we know about things that have worked in the past, and give ourselves the highest chance of making money. So the highest chance of making money if the market doesn't look the way we expected, the highest chance of making money if things change, if Trump says something stupid, if new entrants come into the market. Um, so effectively, what we kind of need to start with is a bit of humility, right? We need to go and we need to look at what has worked in the past, what has worked in the past for a long time, what is relatively sort of robust and easy for us to monetize, even if things change, even if things go wrong, even if the market sort of changes underneath us. Because the one constant that we know about is everything is changing underneath us. The market is a competitive environment. People are smarter than us. And we need to do things that are very, very likely to make money. So that is my anxiety, right? My anxiety is, what if everything changes? What are we going to do? What if things go wrong? How are we going to make money? And any sensible approach to this should be built on top of shit that's worked everywhere, stuff that we're really confident about. So there's a variety of fairly non-exciting trades or edges in the market that have worked for decades in nearly every single asset class that exists. And that's things like trend following, there's things like momentum, it's things like carry, which is buying things that yield and pay us money. And we have sort of crypto native versions of these kind of simple trades, which is like putting money into liquidity pools and things like that. So at the sort of, we can picture what we're trying to do in order to make money as some kind of pyramid that gets smaller as we go up and harder as we go up. And what we want to do is we want to like have a big bottom here, right? We want to massively overweight the stuff that is likely to make money even if things change, likely to make money even if we're a bit shit, right? So we want forgiving stuff that has like a long track record of making money. Then on top of that, we can afford to try and be a bit smarter, right? Because if we just traded this stuff, you know, FinRev is this stuff, right? FinRev is the bottom of this pyramid here, and you kind of know what the experience of trading that is, right? It can go nowhere for a long time. It can shoot up. It can go nowhere for like a year or something. It can shoot up. But we have in HyperTrend the advantage of one, only trading on one pool of capital, and two, world-class execution that can take advantage of short-term prices. So
Would you
that
mind digging into that advantage of one trading one pool of capital is much better than the way we're doing it now, where everyone has 2,000 accounts and they trade their own.
Yeah, so one advantage is simple. It's that we can have reduced fees on that stuff. The other is that we can scale into positions over time. So like rather than FinRev, where like everyone's orders are kind of being staggered out, right? And sometimes you might get lucky, sometimes you might get unlucky on where you appear in that queue. we have full visibility over the positions that we're working into. So I'll come to what our trading system ends up looking like, but effectively what we're doing all of the time is we're trying to predict what positions we want to be in over the next few days. And then the trading system is trading literally all of the time. Like it's trading slightly towards the positions that we want to be in, and it's trading slightly away from the positions that we no longer want to be in. So even though our sort of average hold position on this kind of stuff is days, we are literally trading all of the time. We're also monitoring short-term prices such that, you know, if you've sat in front of Hyperliquid and you've seen what happens, sometimes someone will just put a massive buy order in or a massive sell order in, and they flush out a whole bunch of levels, and the market takes a bit of time to come back. Now, when that happens, if we needed to sell something, we would sell very quickly. We would get aggressive at that point because we can take advantage of those short-term price things that happen over sort of seconds and minutes. So even though our trading looks more like FinRev than it looks like a high-frequency trading setup, we still have the advantage of taking short-term good prices. That means
it's
that,
like if FinRev had sex with a high frequency trading system. This is the
yeah, exactly. It's like the bastard child of FinRev and like a high frequency setup. Yeah. Yeah. So what that means is that allows us to take advantage of some things that are usually harder for us to trade. You know, things that are faster, things that are less liquid that we can get less money in. So on top of this kind of basic base that we've created, which is like mostly trend and momentum and a few yield plays, right? We add on things that are a bit harder to trade, things that are a bit more uncertain, things that are a bit more idiosyncratic. But the way we're putting this together is even if everything changes and this stuff doesn't work, or, you know, someone big comes into the market and gobbles up all of these opportunities such that we can't take them, we still have this base of our portfolio that we're very, very confident is going to make money. So we're sort of taking a realistic approach where we're overweighting this stuff. We are still getting involved in this stuff because we would like to make money most of the time, right? We don't want to sit there throughout a 12-month drawdown, ideally, right? So we add this stuff on, but we're being realistic about it. We're going, hey, look, what is going to give us the best chance of making money in all environments, and what are we most certain about? So the kind of process for us to go through that is relatively simple but time consuming. Right? We're not trying to be smart. We're not trying to reinvent anything that doesn't already exist. We're not trying to come up with particularly new, smart, newfangled ideas. You know, it's not like we don't get prizes for creativity or something like that. We just need to make money. So our approach is to go, well, hey, look, what is an idea that makes sense? What is an idea that we know for sure has worked in other markets? And then we will go and look to see if that works in crypto. And, you know, nearly everything that used to work in stocks, nearly everything that used to work and still works in future markets tends to still work in crypto and work much better because it's a immature market and it's relatively sort of distributed around various venues. So there has been a few things that we've looked at and gone, for whatever reason, sometimes that we can understand, sometimes that we can't understand. Something that worked in stocks doesn't work in crypto, or even something that works in stocks works the other way around in crypto for reasons that we don't really understand. But generally, we're seeing what we expect to be the case. We're seeing short-term reversal patterns, we're seeing longer-term trend patterns, we're seeing things behave differently depending on the amount of traded volume and things like that. So we have this sort of list of ideas, and then we went through them and we investigated, does this work? And then given that it works, we have to confront the real world, right? We would, you know, anyone can create some kind of simulation of buying new highs or something and see that it would have made money if we did it perfectly. But trading costs money. The more we do it, the more we lose money and the more we have to make up for those losses from trading costs. So we need to think about boring stuff like smoothing. We need to think about the fact that if we can only predict the next hour's returns, that might be untradeable. And that's sort of boring work that we go through. It's time consuming. It's creating lots of plots. I'll show some examples. But ultimately, what we end up is a bunch of stuff that can predict returns for each asset that we trade, each coin or each perp, over, say, the next day. Then our job then is sort of not really very sophisticated, right? We take all of those things that slightly explain returns over the next day, and then we just kind of jam them together in order to get some kind of prediction of where we expect each coin to move. And then our job is to just make sure that we're more long the stuff that we want, that we think will go up, and we're more short the stuff that we think will go down. And we probably don't have much of a position in the stuff in the middle. And our job apart from that is just to make sure we're not taking too much risk. Are we too big in anything? Are we too big in certain kinds of things? So the actual kind of process is time consuming, but it's relatively simple. It's easy to understand. We are basically shamelessly copying ideas from everywhere. There is absolutely nothing really unique in the portfolio, but when we sort of jam a whole load of good ideas together, we end up with an approach that's quite likely to make money. So I did not talk to Scott before this about what he was going to talk about, but my example I was going to show you was pretty much exactly the thing that he was talking about, which is that if you need to trade right now, you have to pay someone who is willing to wait in order to trade. So if I want to sell my coins, I'm going to have to do it at the bid, right? I'm going to have to do it from someone who is sat there waiting to buy, which means I'm going to receive a lower price for selling my coin. If I want to buy, I'm going to have to buy from someone who is sat there willing to sell, right? Which means that I am going to have to pay a higher price for the coin than I would do otherwise. And we can look at this, right? That CBD thing that Scott was looking at is essentially the amount of trading that happens over here, i.e. someone who is aggressively buying, versus the amount of trading that happens over here, ideally, someone selling. And this is sort of works exactly the way that you would think it does, which is that an increasing amount of people aggressively buying looks a lot like a trend effect. An increasing amount of people aggressively buying tends to kind of continue, and it makes the price go up. So very simply, more buying just makes the number go up. And you can see here, this is part of our work that we've done where we go, hey, look, this is an idea that makes sense. This is an idea that works in other markets. We know that this is sensible. We know it works pretty much everywhere that we've looked. So we go and we say, hey, look, how can we quantify that? And that's quite simple, right? We just look at the amount of buy volume that's going on over the total amount of volume traded. And then we look at increases in that, right? We look at, hey, look, is there more aggressive buying happening now than was before? And we can kind of sort that thing, like we get a number for every asset and we can sort it along this x-axis over here. And we can plot the next day returns against it. And you can see we've got this lovely up and to the right pattern here, where the more aggressive buying is increasing, the higher the returns we see in that name next day. The more aggressive selling is increasing, the lower the returns in that asset next day. So this looks like a beautiful trend effect, right? So this is the first thing we do, right? Everything we look at, we go, well, does this make sense? Do we know it works somewhere else? Can we quantify it? In the simplest way possible, can we show that the number that we come up with for each asset somehow predicts the next day or next hour or whatever it is returns of that thing? And we end up with a scatter plot that should go up and to the right. And if it goes up and to the right, we're not happy. Well, we are happy, but in fact, the work isn't done at that point because we need to think about the real world. this is not the real world. Right? This is going, hey, look, if I just imagined that I was able to get long the coins over here and short the coins over here every day or every hour, I think this is, then theoretically I would have made money. That's pretty good, right? That is for one simple idea, just being long every single perp on Binance. I think this was based on that indicator. We look like we've made money. But our job is not finding this and just jamming it all together, because we have a whole load of sort of real world things that we have to think about. And I'll just give you an example of one of these so that you can see it and you kind of know roughly what we're doing and like kind of what we're doing with our time. If we plot that aggression signal for Bitcoin, you can see it kind of wiggles around quite a lot. It's actually quite well behaved. If we plotted one of the FinRev trend models, one of the longer ones, it would look sort of more like this, right, Scott? Like it would kind of look like that. It would be this nice, well-behaved, sort of smooth signal. But this order book stuff, it's more noisy. And if you imagine what our trading model is doing, it wants to be kind of maximum long over here, it wants to be maximum short here, and it wants to be constantly changing its positions. So you can see we would be like zipping long, short, long, short, long, short all over the place if we traded this raw signal. Now, the important thing is every time we trade, we lose money. So we would much rather have something that looks like this than something that looks like that. And it turns out that we're quite lucky in that there's not that much information going on here. Like lots of it is noise. And when we smooth our signals, which we do a lot all the time with nearly everything, we don't actually take that much of a hit on it. So here's the thing. This is the thing that I showed you before. Here I smoothed this thing with, I think, a 7-day half-life exponentially weighted moving average, just like a EMA in TradingView or something like that. And you can see if we take the same kind of back test without any cost, this is the non-smooth one. This is the smooth one, right? Like we have lost something. This is more jumpy. This is not quite as nice as this, but you would struggle to be able to infer that much from just looking at these things. So what we're doing is we're constantly kind of wrestling with these trade-offs. We would like to trade as slow as possible, but sometimes we can't trade slow. Sometimes we can only predict over the next few hours. Sometimes we can predict over multiple days. There's also a bunch of other stuff that we need to think about and we're doing. One that's pertinent to this example and also your trading is that we trade on Hyperliquid, but Hyperliquid trading is somewhat idiosyncratic and not representative of the entire market. So very simple signals like, say, the percentage of buy volume that's going on is going to be much noisier on Hyperliquid than it would be on, say, Binance. So lots of what we're doing when we're calculating these kind of things is we're taking volume signals, we're looking at that sort of buy volume expansion on Binance data, and then we're using that to trade the equivalent Hyperliquid tickers on it. And that's just
and by the way, that's completely idiotic, completely against all sorts of quant things, and it works much better for reasons that we understand, but it's also something that most nerds would not do, right?
Yeah, probably not, right? And it does, it does make sense, right? Like if we're these things are sort of blunt, stupid, like these are not smart ideas, right? These are kind of blunt, stupid quant ideas. So we want the least noisy data, and we want the stuff that's most representative of the market as a whole from this stuff. Other stuff, what we're doing day to day, what we have been doing, is we know what we're trading, right? We know that we've got a whole load of stuff that predicts returns. We know what it is. We stole it off other traders. There's nothing new under the sun going on here. But we're in an iterative process where we're trying to work out the trade-offs of how we deliver the best returns at the minimum trading cost. and at an acceptable level of volatility and risk. So all things being equal, we prefer signals that are slow over signals that are fast. We can't always get away with that, right? We can only trade what's in front of us. So some stuff necessarily is going to be jumpy, and some stuff like trend is going to be smooth. But we prefer the smooth stuff over the jumpy stuff. We also prefer stuff that predicts longer term returns. Trend is brilliant for this, like actual trend following, like the stuff that's in FinRev, like because a trend feature will hold up over like weeks, right? Like a medium term trend feature. Whereas some of our like seasonality stuff will only play out over the next 4 hours, really. So we prefer that longer term stuff, even though it doesn't quite look so good in a simulation, because it's going to work better in our portfolio and it's going to help things. We also prefer things that work well on liquid symbols. Like if you are a small trader, there are tons of edges that you can get that work on the short side with absolute dog shit liquid names. Like there's just tons of stuff. If you're prepared to sit there and scale into dog shit positions on shorts, there's a
You
ton
want to
of
just
stuff.
tell them a couple of those now because it's stuff that like home click traders with small accounts should really be aware of because it's like the lowest hanging fruit, right?
Yeah, so like basically you just want to be shorting anything that's so any new listing after a few days, right, is a good short. Anything where the funding rate gets incredibly volatile and crazy tends to be a good short. Anything that's sat down near lows, like recent lows, tends to be a good short. Like there's kind of there's tons of stuff. Also on crap, on dog shit, anything that has pumped recently tends to be a good short. You see very very heavy reversion patterns in crap stuff. Um, so yeah, we can go through more of that. So, but we have like
Oh, that's
Artem,
plenty.
our researcher, has found absolutely tons of stuff that if we could trade absolute dog shit, like we'd be able to trade. But unfortunately, we can only trade so much of that, right? Like, so we much prefer, because we're going to be trading a fair amount of money, we much prefer things that work well on liquid stuff. Thankfully, trend works better on liquid stuff than anything, right? Like, so lots of our kind of trend models naturally fit with this stuff, and we have a lot of large cap things that we can trade. So, to Scott's point, like if you looked at our portfolio, largely speaking, we'll probably be net long big stuff, and we'll be net short small crappy stuff. As is the way, like indiscriminately just shorting anything that's crap is quite a good trade in crypto. Um, the final thing, like we just want stuff that's different. Like ideally, we want stuff that's different to other signals. This is somewhat hypocritical because nearly all our signals are either momentum or they're reversion or they're trend, right? So nearly all of our signals, including the aggression one that I looked at in this example, basically look like trend. They look like continuation. But we've got some other stuff. We have some funding rate plays. We have some seasonality plays. We have some stuff I can't talk about that I stole off my friends that is sort of different to trade and reversion, but kind of constructed from it. And generally, we've got a bunch of trend following features and we've got a bunch of other stuff. We would love to have more other stuff, but we can only eat what we're fed, right? We can't create edges that don't exist from the market, however much we want to. So largely speaking, we end up with all these things, we jam them together, we make sure we're not taking too much risk, and we do simulations like this. So this is a simulation of our core models. So this is basically trend, momentum, seasonality. So basically the bottom of the pyramid traded on hyperliquid perps. And you can see that, in the last half of the year, it did very well. Probably, some of that is luck, some of it is not, some of it is skill. But our job is to keep refining this, keep refitting it to market conditions, keep thinking about what's going on, keep investigating all of the trade-offs around how much it costs to trade and how often we want to trade. So finally, like the actual trading system looks like this. What I've talked about over here, well, for the whole talk, is finding stuff that predicts whether a token's going to go up or whether it's going to go down. That's what we do here, and that's 90% of the job. Like, if we can do that, we don't have too many other problems. If we can't do that, no amount of smarts anywhere is going to make our life easier and go and make us money. But our system basically is running all the time, calculating what it thinks the expected returns over the next day or so are going to be for every asset. And then it's going, what positions do I want in order to make the most money within my risk tolerances? So we sort of assess the risk of every symbol, we assess how much we think it's going to move, and then we end up with basically a bunch of positions that we want in every asset. Very simply, we then compare the positions that we want to the current positions that we have, and we get a set of differences. And if our current positions are close to the positions we want within some tolerance, we will do nothing. We will do no trading. But if it's out by a sufficient amount, we go into the market, and our partners, Deep Forest Research, who do our trade execution, are going to start trading towards the positions that we want and trade out of the positions that we don't. And that is a constant thing. So my job here is this big loop here, but our actual trading is going to happen constantly all the time. We're just going to be trading constantly and in tiny amounts into positions and out of positions. And those positions are going to be changing underneath us, so it's kind of a dynamic thing, but the thing's going to be just trading all the time, such that our positions that we have are as close as possible to the positions that we want. So it's just a big loop. It's very simple. I've taken you through effectively everything that we're doing. That is the whole trading model. It is conceptually simple, but there's a lot of moving parts, and it involves being quite careful about each of the bits. Was that helpful? Was that a helpful insight into the chaos?
That was the best vulgarization of incredibly, like, this is so complicated. This took me like 5 years to even understand. Yeah.
Yeah, I mean, it's not. It is complicated. It's not. I think it's not conceptually complicated, but it is. There's a lot of bits, right? And we need to make sure it all works, and we need to.
I think the bottom line is this is the final form of what a state-of-the-art trading system would look like. Like, you would improve it a bit to get it to state of the art, but it's not. It's within spitting distance of something that you do with unlimited money and unlimited people, right?
Yeah, it's like it's 80% there, and like people like us never go over 80%, right? And we shouldn't, right? Like, we need to make money with high probability. We need to make all of us rich on this call, right? And we need that line to go up and to the right. We don't need it to go up and to the right every single day, right? Like, we need to make money, and we need to make money with high probability, and we need to do it well, and we need to do it quickly. Like, we need to get it done.
Fuck, man.
Oh yeah.
So good.